Have you ever seen global markets just humming along one minute and then completely fall off a cliff the next? Sometimes the trigger isn't some massive economic disaster. It's something way, way smaller, like a single name. Today, we're going to dissect exactly one of those events to really understand the fragile psychology that drives our entire financial world. I mean, it sounds kind of crazy, doesn't it? How can one person's name, just spoken in an announcement, send stocks, crypto, and everything else into a total nosedive? Well, we're going to break down a fascinating case study of how that can happen, and in the process, reveal the hidden triggers that really move modern markets. So look at this. One moment, the market's looking fine, even positive. The next, boom, a sudden sharp drop right across the board. This wasn't a slow burn or anything. It was an immediate, almost gut reaction. So what on earth could cause a panic that sudden? Well, the trigger, as it turns out, was a single political announcement. An announcement that sent these massive shockwaves through the financial world and basically turned everyone's expectations upside down in an instant. And there it is, the catalyst, the news that Kevin Warsh would be the new head of the U.S. Federal Reserve. Now, to most of us, that might just sound like another political appointment, right? But to the market, that name carried a very specific and very scary meaning. It was enough to spark a huge sell-off. So who is this guy, Kevin Warsh, and why does his name carry so much weight? To really get why the market crashed, we have to understand the man. Or actually, it's more about the story the market tells itself about him. So Warsh is no stranger to the Fed. He's a former governor, and because of that, he's built up this very specific reputation in financial circles. He's known as a hawk, which is basically someone who loves what's called tighter monetary policy. Now that phrase, that's the absolute key to this whole story, and we'll break down exactly what it means in just a sec. And this right here, this is the core engine of finance in action. The market didn't crash because Warsh actually did anything. I mean, he hadn't even started the job yet. It crashed because his appointment created this powerful expectation of what was about to come. So let's unpack that central fear. What does this whole idea of tighter money actually mean for the markets and for your wallet? So to put it simply, monetary policy is just how the central bank controls the flow of money in an economy. And the Fed chair, they're arguably the most powerful person in the world when it comes to this. They can make it easier or harder to borrow money, which, as you can imagine, has a huge impact on everything from your mortgage to the stock market. Okay, so investors basically live in one of two worlds. For years, the markets had been swimming in an easy money environment, right? Borrowing was cheap, and that fueled all kinds of risk-taking in assets like stocks and crypto. But Warsh's name, his name, is associated with the complete opposite, a tight money world where borrowing is expensive and investors run away from risk. So that announcement was like a giant flashing neon sign. Traders everywhere took it to mean one thing. The easy money party might finally be over. And they didn't wait around to see if it was true. They acted immediately on the fear that it might be. But fear by itself doesn't really explain the speed and, the sheer scale of the crash. The initial selling was actually amplified by a really powerful and dangerous financial tool. And that's what created this devastating chain reaction. First up, let's talk about leverage. This is when traders use borrowed money to make way bigger bets. You can think of it like a power-up for your investment. It can multiply your gains, for sure, but it can also multiply your losses, and that makes the whole market incredibly fragile. And that brings us to liquidations. When one of those leverage bets goes wrong and a trader's losses get too big, the exchange just steps in and automatically force sells their assets to cover the debt. This isn't a choice, it's an automated and often really painful process. The crypto market, which is famous for its high leverage, got hit particularly hard. As the price of Bitcoin plunged down towards that $75,000 mark, it crossed this critical line in the sand for thousands of leverage traders. And that set off a massive automated wave of forced sales. And here's exactly how that spiral worked, step by step. First, you got the initial fear-based selling, which pushes prices down a bit. That little drop then triggers the first wave of automated liquidations. Boom. Those forced sales then flood the market with even more stuff to sell, pushing prices down even faster and further, which of course triggers more liquidations. It was just this vicious, self-perpetuating cycle. So when we zoom out from all that chaos, what does this whole event really teach us about how modern markets work? The key takeaway is actually both pretty simple and pretty profound. Okay, so here's the entire story in a nutshell. A name created an idea. That idea created fear. That fear led to selling. And then modern financial tools like leverage turn that little bit of selling into a full-blown crash. A simple change in what people thought was going to happen, amplified by technology, became a painful financial reality. And that leaves us with a really fascinating and, maybe a little unsettling question. We like to think of markets in terms of solid numbers and fundamentals, but if an entire crash can be triggered just by a feeling about the future, what does that say about the foundation of it all? I mean, what are these markets really built on?